Welcome back to DIY Finance Guy. I'm Sergey Modilevsky, and in this video, we're going to cover the economic report from the Royal Bank of Canada, forecasting that benchmark national housing prices will decline another 14% by spring 2023, more so in Ontario and British Columbia. I'll explain the reasons why and provide catalysts that could change that forecast. All that and more, let's get into it. Robert Hogue, Assistant Chief Economist with Royal Bank of Canada with 33 years of experience as an economist, anticipates that Canadian benchmark prices will fall another 14% by spring 2023. Let's discuss the factors that'll catalyze this downtrend in prices. Prices will continue to be suppressed by the worst housing affordability the country has ever seen. Expectedly, the worst affordability is in the Greater Toronto and Greater Vancouver area, but many smaller markets are also looking pretty dire. Areas like Hamilton, London, St. Catharines, Windsor, and Kitchener-Waterloo are seeing the highest mortgage carrying cost to median household income after home prices surged over the last 2 years. Get into the comment section and let me know. Do you think home prices will continue to fall between now and spring 2023, or do you think the market has already found its bottom? Let's jump back into it. In the midst of this affordability crisis, borrowers must also contest with the highest mortgage qualifying rates since 2001. This is the result of the mortgage stress test, which adds 2% to current mortgage rates when someone applies for a mortgage. This limits their borrowing capacity by about 20%. Because instead of qualifying at a rate of 5.19, for example, they must qualify at a rate of 7.19. It's difficult to secure the mortgage to purchase a home, while at the same time, a source of down payment is also becoming harder to come by. Eroding household wealth in the second quarter of 2022, Canadians saw their net worth fall by nearly $1 trillion. It's the biggest drop in history. That's a 6.1% drop from a year before. Average household net savings for folks aged under 35 cohort have fallen around 60% since peak savings in the second quarter of 2020. It's important to consider that these values from Statistics Canada have a significant lag to them, and they don't include the stock market downturn that's accelerated over the last 30 days. Even bond funds, long considered to be on the lowest tier of risk, have seen a 12% decline in the last year. Over the last 12 months, a 60-40 investment portfolio, a staple for the retiring boomer and Gen X generations, has seen its largest decrease since 1936. Speaking of boomers, the bank of mom and dad has temporarily shut its doors. Never before has the number of people nearing retirement been so high. If they still have their own mortgage payments, many parents have seen their payments increase by up to 40% since March. Even if they've been in a fixed mortgage, many borrowers will see their mortgage payments jump at maturity due to higher interest rates. Once in retirement, parents are no longer able to provide any tangible assistance as a co-signer on their kids' application. In light of falling home prices, stocks, and bonds, parents aren't feeling inclined to pull from their retirement funds to supply down payment assistance for their kids. If parents wanted to borrow from their home equity, they're now facing an additional 3% of borrowing costs compared with March of this year. Ouch. With interest rates having climbed so quickly, parents with savings can now invest their own money in high-interest saving accounts and GICs and earn a risk-free rate of return between 3 and 5%. Who couldn't use some extra passive income in times like this? It's becoming increasingly clear. Most new borrowers are going to have to go at it alone. When homebuyers decide to go shopping over the next 2 quarters, they're likely to find a lot more housing supply than they have in Q1 and Q2 of 2022. As borrowing costs rise and inflation continues to remain elevated, more borrowers will be forced to list and actually sell their home. There's a growing sense of urgency as many variable rate mortgage holders have surpassed their trigger rates, and some of these homeowners will conclude that they can no longer burden the cost. Alternative and private mortgage holders will be faced with fewer options for financing and a much higher cost of borrowing at their upcoming maturities. Most of these products are held in 12-month terms. We've discussed the 5 primary factors that support the Royal Bank of Canada's forecast that prices will continue to decline between now and spring 2023. But what occurrences may stop that fall? Before we jump into that, if you're enjoying the video, please hit that like button. It would mean a lot to me, and it'll get this video out to the people that really want to see it. Let's jump back into it. The last 7 months have been a stark reminder that asset prices, including real estate, are driven almost exclusively by interest rates. The Consumer Price Index report for September will be released on October 19th. Should the headline and core inflation figures report well below forecast, That could catalyze a big shift in consumer sentiment on the expectation that the Bank of Canada will stop hiking interest rates and bring forward the date for any future rate cuts. It's also worth noting that we saw a US release confirming that job openings have come down in a really dramatic way. That means that there's less pressure on the labor market, less available jobs, same number of applicants, mean that employers could be a little bit more flexible with offering lower wage in order to retain new workers. This has led to a huge market rally in stocks over the last couple of days, and it's just one indicator to keep an eye on as we await the Consumer Price Index report. Another meaningful policy shift would be the removal of the mortgage stress test. This would immediately create an additional 20% of borrowing capacity for interested home buyers. That would create a higher price floor in the market. No changes are imminent at the time of filming. If you've enjoyed this video, please hit that like button and consider subscribing to the channel so you don't miss any of these videos in the future. Hit the notifications bell so the algorithm pushes my video above the cats playing with yarn. Thanks for tuning in, keep well, and I'll see you in the next one.